Welcome back to the Responsibility of Investing podcast series. In this podcast, we're going to dive into the data provided by our 5,000 signatories in the most recent reporting cycle. It tells us about what commitments signatories are making and how they're putting those into action. My name's Toby Belsom. I'm a Director of Guidance and Reporting, and I'm delighted to be joined this afternoon by James Alexander, the CEO of the UK Sustainable Investment and Finance Association, and he's also chair of the Global Social Investment Forum. And Mette Charles, who is ESG lead at Aon Investment Consultants. Thank you both for joining me today. Before we start the discussion, I wanted to provide some context on the analysis we've undertaken on the PRI reporting data and kind of pick out 5 really high-level themes or points that I certainly come through in the way that I've read the data. And the first one is that reporting kind of still matters. And this was the largest ever year for PRI reporting, with over 4,200 investment managers and asset owners, signatories participating. And considering the rollback we've seen across regulation and political pressures over the last 12 months or so, I think that was certainly something I found personally pretty surprising. The point 2, or the second, is that one around climate is king. Climate remains the primary issue across our signatory base, whether it's making commitments or including climate risks in portfolio construction. Third one, global agreements are not dead. The geopolitics has meant that many governments are now rolling back from global agreements, yet Paris, UN, global principles, and others remain pretty foundational frameworks for a large number of our signatories in the way that they set out their wares, the way that they set out their commitments. Point 4, transferring those commitments into meaningful actions remains a bit of a struggle for the signatory base and the industry more broadly as well. Taking for example, the UN global principles for human rights and putting them into action, practical action, or impacts on portfolio companies is a difficult task. And finally, value creation is a really key mantra, a key theme in this year's data set is the rise of that term, value creation as a driver, a way of justifying and explaining actions at a portfolio or asset level. Signatories can view that data and lots more detail around that on our My PRI platform. And a public summary of some of those key themes is available in 2 public blogs that you can find in the resources page on this podcast. James, Mette, again, thank you for joining us. I want to let yourselves introduce yourselves and the role that your organizations play in the RI landscape. James, maybe turning to you first with both hats on in a sense.
Yeah, sure. Thanks, Toby. So I'm James Alexander, Chief Executive of UKSIF, which is the membership network for sustainable finance in the UK. And I suppose my second hat, I'm chair of the Global Sustainable Investment Alliance, which brings together many SIFs operating in various countries across the world. So SIFs operate in almost every European country, the US, Canada, Australia, New Zealand, Japan, and we bring them together on this global alliance. And what we do is I guess on one level, we share experiences of running SIFs and what's happening in each country. But more broadly, we engage with policymakers on the international level. We give a global perspective on sustainable finance and where it's moving and how it's going. And I guess what some of the barriers are to adoption and to further advancement of sustainability through financial services. And also we publish research. And so last year, 2025, we published the 7th version of the Global Sustainable Investment Review. We've been publishing it every couple of years. And it shows the change in the movement, or I suppose the growth of sustainable finance approaches across the world over the last more than a decade. And it's pretty amazing what we've seen and what we found out. Sustainable finance has definitely moved from niche to a systemic consideration. Disclosures are improving, but I think are still, in many areas particularly incomplete, and we're seeing more regional disparities there. And stewardship is by far the most dominant approach that investors use around sustainability. But there are still challenges. There's a lot to do, and capital movement still does require policymakers to act. And that's one of the key things that I think you just pointed out. Value creation is the mantra. How do we make sure that this is creating value, that we're looking at ESG from a risk perspective, and also that policymakers are helping drive capital in the right direction?
Thanks, James. Mette, over to you.
Hello, thanks for having me, Mette Charles, ESG research lead at Aon. So we're an investment consultant. So we're sitting in between asset owners and asset managers, and the RI specialists within Aon. I mean, we cover quite a lot of things. We help clients understand, orientate themselves towards RI, and here I'm sort of got an investment stewardship hat on. So we help them across the board in terms of how they report, training topics, and in terms of bringing knowledge to the table, in terms of what's happening, what's evolving, what's changing, what the risks are going ahead. We help them with their EPIS, their DCFD, PRI reporting, UK stewardship code reporting. And I also sit on the ICSWG, which is the Investment Consultants Sustainability Working Group, which is 19 consultants now, so representing investment stewardship and RI within the financial industry.
Thanks, Mette. Just kind of going straight into, some of those points that I highlighted right at the beginning, the points that are themes throughout the data set that we collected from a very large number of signatories last year. I mentioned that global agreements are not dead from the perspective of our signatory base, and maybe that conflicts or contrasts with what we're seeing at a governmental level. I just wondered, James, if I could turn to you to reflect effectively on that seemingly conflict between what you're seeing at a government level and maybe what we're seeing among our signatories and the industry more broadly.
Yeah, I think you're right. Global agreements are not dead. We are seeing still a huge amount of progress and movement on the global stage. Now, clearly, different countries are doing things in different ways. We can go into some of what's happening in different countries. A lot of it will be very obvious and well known. But there is an awful lot of activity still happening at the intergovernment level. That's not to say that there isn't activity happening at the level below that. But global agreements are still very important for driving activity. But there needs to be more. I think one of the core reflections we're seeing from GSIA is that things are not moving as fast as it needs to. Finance is not playing the key role that it needs to be playing in addressing some key global sustainability challenges. But one of the reasons for that, and we've reflected on this quite a lot, is that governments have almost left investors high and dry. At COP26 in Glasgow, it was an amazing event for the UK to host. There was an enormous number of companies and investors came together to create net zero targets. That was an amazing example of investors, governments, and companies all working together to point all in the same direction and say, yes, we're all in this, we're all moving together in the same direction. A few months later, the Ukraine war started. We saw cost of living crisis spike, oil prices spike. Government's attention was diverted elsewhere. And I think in the years following that, there's been a sense from investors that we're moving ahead, looking at issues around climate change, doing stewardship and engagement around climate and sustainability, pushing companies for their transition plans. And the government policies that we thought would be coming in behind that have not followed. And so we're kind of almost investing in an economy that's not existing. And so no wonder then that governments the investors are kind of saying, well, hang on, if governments aren't with us on this, how are we able to invest in creating a future that's not necessarily driving in the same direction? So I think there are some challenges there, but yeah, what happens on the international stage does still matter. Governments working together do make a huge difference, and these frameworks are important. None more so, I think, at the moment from a disclosure perspective than the ISSB framework, which is looking at incorporating corporate disclosures and transition plans in a standardized framework that will kind of work across the world.
And Mette, from your perspective of the clients that you're dealing with, have they taken a different attitude to global agreements over the last 12, 18 months or so? Or is it fairly similar?
It's fairly similar. When James is saying not driving in the same direction, there's been a slight change in language towards the need for systems change. And that is because you need all actors to be playing in the same direction. Otherwise, it's just too hard. I've got an example of a client that we were working with who we tried to help them set their net zero target, for example, and they wanted to show leadership by setting a fairly ambitious target of being net zero by 2040. And we ran it through climate scenarios and we did all the analytical work. But it was overly ambitious. It wasn't realistic. So we had to bring that down to 2048. And it was because there just aren't enough managers within their portfolios who are also trying to be that ambitious. They're very reliant on the government and policy, on investment managers and on investment opportunities to be that ambitious.
Mm-hmm. And going to climate, I mentioned right at the beginning, climate's king. It remains the number one issue across the PRI signature base, a very important and key theme from the data that we collected. I don't know whether you've got any examples of kind of leadership in that space, really interesting, innovative practices, which gives you a bit of a cutting edge kind of feel, real area of progress and innovation.
There are pockets of leadership in various directions. And in terms of clients, it tends to be the larger, more sophisticated clients who have the resource to be able to push. And some of the managers who are in industries where data's hard, comparables are hard, they are pushing. And it's hard to work out how to overcome those challenges. I mean, one example where a client was trying to be very ambitious again was just in data. So instead of pushing on the net zero target, we're pushing on the data transparency so that they can get more data in order to get better signaling and be able to measure and monitor going forward.
Thanks, James. I don't know whether you're seeing other emergent issues creep up among signatories at the SIFs globally or at a kind of more global basis.
Yeah, I mean, well, first of all, I'm not surprised to hear that climate remains king. It's financially material. It's measurable. There are sort of systemic risks associated with it, and of course, there's a strong regulatory architecture that's been built around climate change across the world. So, not surprising that's got a lot of momentum. We are, of course, seeing nature moving up the agenda, AI, the ESG risks associated with AI, and I think the opportunities that AI brings. We're only just scratching the surface of those. And of course, AI technology is continuing to change and become more embedded in our day-to-day lives and in the lives of companies that we're invested in. I think some other things, though, that are also coming up are physical risk. Definitely feels like it's coming higher up the agenda. When we saw wildfires that burned down big chunks of Los Angeles, if a city like LA can't protect itself from climate risk, then everywhere potentially is vulnerable. And we're seeing that in the context of insurance, in terms of how companies are valued and assessed. We're seeing disclosures, a big focus on disclosures, both from a fund level disclosure, but also corporate disclosures with ISSB and transition plans. And then finally, we're seeing an alignment of regulation, particularly in Europe, with competitiveness and economic growth. So it's about looking at these regulations in a slightly different way. What is the purpose of doing this? There's a risk and growth competitiveness angle to that now too.
I'm just thinking, going back to the climate and data, is scope 3 and starting to look at supply chains and upstream scope 3 rather than trying to do everything. That's another big one, which is an important one.
And looking outside that list that James kind of painted there, Mette, on AI, on kind of economic alignment, let's call it, on physical climate risk. There are other things that are starting to join or be introduced in the conversation with clients that you're having.
Yeah, well, there are those, but nature is a big one, and it's a very quiet one because everyone's finding it very difficult to understand how they can tackle it, and we're having the same problem. But trying to bring complex problems and intuitively help clients understand how financial materiality and ecosystem services bring an impact on the different production processes of different companies, which is highly site and location specific, is really hard. It's not a problem that's going to go away. TNFD is around the corner. That is a really, really tricky one that I think is going to become louder over the next year.
And what have been the initial steps your client group, I guess, have been taking in trying to introduce commitments relating to nature, commitments relating to reporting and data around nature?
If you look at TCFD, the recommendations, the 11, and you look at the TNFD recommendations, they're very, very similar, except that for nature-related risk, it brings location and it's highly specific to the company. And you find that data doesn't really get you very far because whatever data you use, it doesn't come in the context of the company and the production process. So you're always left with the so what question. So what we've done, and I think a lot of managers have also done this, is using Encore, ENCORE, which is freely accessible. And what they do is they give you the financial materiality of the ecosystem services, and you can apply that through a mapping to your portfolio. So that gives you a very good starting point. And what we then found is what we had to do is you've got to triangulate, because I don't see where really you can go from there with ease unless you pay for a lot of data. And even if you pay for a lot of data, I'm not sure where you have to go to the company's sustainability report and start to do a deep dive as to what they are reporting they're doing, I think.
Is that Mette, though, one of the positive use cases for AI? And I think that data industry, as we know it right now, that has to mine through thousands of pages of corporate reporting is going to be completely upended by AI approaches, it seems.
One of the other themes, those points I mentioned right at the beginning, was about transferring commitments into meaningful actions and how difficult that is in kind of reality. How that step about making a commitment at a portfolio or organizational level to making a real world impact at a corporate or investee or asset level. What, I suppose, do you think are the key barriers to that? And how are you seeing clients for you, Mette, and members for you, James, respond to that challenge?
Yeah, I can give it a go. I mean, obviously, Mette talked about data quality and some of the challenges around data and comparability. In the UK, for example, there's some work around ESG ratings providers at the moment, and so there's some regulatory work around trying to look at that. Scope 3, I think Mette also raised, is extremely hard to understand and to kind of get an accurate assessment of, particularly without double counting once you've got very large portfolios. We're also in a world of short-termism, where valuations, mandates, political, government cycles all feel very short-term, and some of the challenges that we're trying to deal with are, by their very nature, quite long-term. They're systemic. They're built in. There's a sense that sometimes people are crossing their fingers and hoping that the systemic risk doesn't materialize during the time of the current mandate. And actually, even if it did, you're still most of the time tracking a benchmark. And so benchmark trackers kind of will incorporate the systemic risks as well. If the market drops, then everybody drops and you're still tracking the benchmark. So, there are some sort of structural systems and frameworks around how we manage investments, how our industry functions, that I think don't necessarily work in the best interests of solving long-term, deep systemic challenges. That's also combined with, many of our members are global investors, but they're working to national level regulatory frameworks, which adds an additional layer of complexity, particularly when some countries are deregulating while others are enhancing their regulations. There's different data requirements, different expectations. And of course, between countries with different levels of development, there are a different availability of data and commitments. And so there's an awful lot of challenges in there that investors are grappling with. And then just finally, just adding on to that, where the incentives lie around, I mentioned earlier, physical risk has become the major kind of challenge, and it's overtaken policy risk or transition risk as one of the key drivers of risk behavior from an ESG perspective. And I think that's a really important and significant shift, and something that we definitely need to think through what the implications of that are.
So I think I take from that, data, incentives, kind of regional regulation as being three key barriers there. Mette, I don't know whether you've got things to add around those three things that James has laid out or wants to add to it.
I was surprised when the FLLC paper came out in February 24, which was the paper that said unequivocally that climate change was a financial material risk, which trustees is incumbent upon them to factor into their decision-making processes. I was surprised that more wasn't made out of that. We're looking forward to the statutory guidance, which is due to come out. And I think that will do an awful lot for trustees to overcome. They hesitate because they have they are also trying to manage tracking error, and they are wedded to benchmarks for good reason. They have to justify what they're doing. So I think that's a big one. And the other big one is a very simple one, and that is simply trustee time and resource.
And then just add in one other thing, Toby, because I think that beyond all of that, there's still a lack of availability of investment opportunities, a lack of places to deploy capital. We talked about GFANs and all these investors that are committed to net zero. And I think it's about now half of the world's managed assets has got some sort of net zero commitment around it. If all of those assets wanted to be net zero tomorrow, they couldn't, because there's nowhere to deploy that capital that would meet those requirements. And so some of that comes to just simple bureaucratic problems around getting planning permission to build things like wind farms. Others comes from the risk associated with policy and the policy drivers that are encouraging capital to be deployed towards things that are more sustainable don't necessarily seem to be consistent or have longevity. And so just finding places to deploy capital can be quite a challenge too.
Thanks. Just moving to a slightly different topic now in terms of regional differences. Obviously, we've seen some very big differences emerge in regional policy as various governments take slightly different tracks on climate and other issues. I wonder whether, on reflection, you think that will increasingly be reflected in signatories. You'll see increasingly regional differences among how institutions approach responsible investment more broadly.
No, it's a big one, and it's one that we've been trying to navigate. And what we have noticed with the change in the administration over in the US is that policy there has taken a different direction to policy in Europe, and that's got repercussions down to what we're seeing at portfolio level. And what we've been very strong on through our engagement program is to try and bring clarity to where and how what a manager's approach is. So the PRI is being brought out the pathways, which I think will go a long way to helping trustees understand the alignment of where their investment manager is. And the ICSWG have also come out with a tool, the alignment tool, to help understand that alignment as well. So I think that's the first step, because they are very different. The global managers who are trying to navigate a global client base are having a very difficult time. And unlike European managers, where they might be prepared to have a sort of sustainable culture at firm level, global managers are delegating it down to product level. And it's understandable. They just have to be clear that's what they're doing.
James, I don't know whether you've got anything to add on that, but particularly as you're looking out towards APAC.
Looking globally, what we're seeing, obviously, the EU kind of retrenching somewhat. I think the sense is that they've gone arguably too far on some of the regulation, and that might be stifling their opportunity to be competitive and to grow. And that's certainly the sense. I wouldn't have necessarily thought that was totally the right angle, but there is definitely a sense of feeling like they've been a first mover. They've made a few mistakes along the way and need to tidy things up, which probably isn't an unfair characterization. In the US, obviously, the political landscape is dominating the headlines, but we're only seeing, I think, from where we sit in the UK, we're only seeing the kind of top line of what's going on and the kind of some of the most unusual, egregious things that are happening. But there's an awful lot going on under the surface that's being underreported in terms of rolling back huge amounts of regulation that's taken years and years to get into place to put, just the other day, rolling back on the climate change or greenhouse gases being harmful, which underpins a lot of the regulatory frameworks that the US has worked on in recent years. And so, there's an awful lot going on in the US that's going to take a huge amount of time to put back into place. And I think in many respects emphasizes the role of longer term managers and longer term asset owners and saying, well, these things are still climate change is still going to happen. These problems are still going to emerge. We can't just, because regulations changed, kind of forget about that fact. We've still got to take it seriously, maybe got to take it seriously on our own rather than with the government support, which arguably is working further and faster. In Australia, there's a lot of work looking at the role of superannuation funds, which are enormous, obviously, in Australia, and the kind of outsized role that a small number of asset owners can play in the system, which I think can be playing a very positive role. Japan's been a really first mover on ISSB adoption in terms of corporate sustainability disclosures, and that's a really exciting thing to see. I think the UK is trying to be hot on the heels of Japan on that one. And then, as Mette has mentioned, in the UK, we're looking at fiduciary duties and the new statutory guidance to give us a sort of stronger statutory underpinning to allow trustees to feel more confident to use fiduciary duties to look at issues like systemic risks and sustainability factors. So yeah, there's a lot going on in different countries. I think what you'll notice though from that list is it's quite different in different countries. And I think that is one of the biggest challenges, and it's a challenge for a kind of global network like PRI, is how to find those areas of alignment across the investor base and how to make that relevant in different countries. And I think that's a core role that SIFs play, is that individual market working specifically with the government and the regulators in that country. And so SIFs and PRI play a very complementary role there. PRI at the global level and the SIFs at the national level, highlighting and promoting to their own regulators and government what's going on.
Mette, this is probably one for you, actually, in terms of another area of difference within the PRI reporting data is between investment managers and asset owners. And you can take a few different data points in there, but one that springs to my mind is the level of public support for the Paris Agreement among asset owners, high, investment managers less so. I just wonder whether you've got any kind of comments or thoughts around how that difference comes about in the conversations you're having with clients. But also, we've seen examples of asset owners moving large amounts of capital from investment manager X to investment manager Y because of this lack of alignment.
We have seen managers pull back from various initiatives. Thinking Enzami, thinking the Climate Action 100. And it goes back to this need to navigate a global climate base and being very wary about litigation further down the line if they're not true to the fund objectives. So there is a difference. There are asset owners who are more free to sign up to the Paris Agreement, and there are asset managers who have to be more careful about what they do. But if I had to say, I think what James was saying earlier is what we're seeing, that managers are doing it anyway. They're just changing the language and maybe being a little more quiet about what they say. But they're real risks. So if they're real risks, they're going to be factoring them in. But it's a difficult environment at the moment in terms of how loud some managers are going to be about what they're doing.
Well, it comes back to that mantra that I mentioned in that last point about value creation being a key kind of underlying theme supporting a lot of action that investment managers are taking. Mette, but maybe I can ask you, we talked about transferring commitments into actions in climate, which, is the key issue that dominates our signatories agenda. Well, what about human rights? One that's really important, but maybe gets less space in terms of the industry debate, I guess.
Well, we have tackled this because in our engagement program we have modern slavery as one of our topics. Managers can do the due diligence in terms of trying to identify where spots of modern slavery might be, for example. But beyond that, if they can't, there's a limit to how much you can probe behind a paywall. So the conversation sort of stops. But now there's one of the large passive global managers we're talking to are undertaking one of the largest surveys on human rights across their investees. And it's a very sensitive topic, not only because if they identify it, there's commercial sensitivities around it, but there's also personal sensitivities around it. So it's very difficult. And it's also very difficult because you can ask questions of a company, but that doesn't necessarily mean that you're going to get the right questions out of their supply chain, or you can only go so far. And I think that's why it's quite difficult.
It's clearly a topic that remains extremely important to investors. Modern day slavery is something we talk about a lot. There's a huge human rights dimension and working conditions dimension on AI as well, and what that's going to do from a social perspective. And then I think there's more kind of on the working conditions piece. There's still a lot of questions to be asked around the gig economy and how that operates. Deliveroo, which is a food delivery company in the UK, a lot of our members, when that IPO'd a couple of years ago, were very reluctant to get involved because its entire profitability depends on the long-term survival of the gig economy in its current form. And so people kind of thinking to themselves, actually, all it takes is a government to come along, kind of like the one we've got right now, that is quite skeptical of zero-hours contracts, of people that are self-employed and working in the gig economy that feel that that's somehow exploitative, potentially with fair justification for that, and that could threaten the entire business model of those companies. There was actually a really interesting example of a kind of social issue the other day, which is in the UK. There's been a bit of a scandal recently around people charging an awful lot of money of ground rent for freehold properties. Sorry if this gets a bit over technical, but the government recently said, actually they're going to be capped, and they're going to be capped at a certain level. Now, what has ended up happening? Turns out a lot of pension funds have ended up investing in quite substantial funds into properties to capture those ground rents that have now been capped. And so I think it's really important that investors don't forget that the fact that policy risk is there. If a harm is being caused, eventually the policy is going to change. I think that's something really key to remember.
Mette, James, thanks for running through those 5 or 6 different questions in response to the points that we've highlighted in the reporting data that we analysed last year. I just wonder whether you've got any kind of final reflection on the discussion as we've gone through.
The problems that investors need to tackle and report on are immense. One thing that you find is that when you start reporting or thinking about how to approach these issues, The basis is always pragmatic. And in reporting to the PRI or the UK Stewardship Code, it's always a pragmatic stance. None of the frameworks out there are prescriptive, specific. There's no right or wrong, but it's just that some action is expected, and however you take it is always a good way.
Thanks, Mette. I'll come back to you with this last thought as well. What's your hope for 2026?
My hope for next year is that all the policy that James was saying is being rolled back, which took years, start to get reinstituted. I really do hope that the governance on the politics around sustainability and the ESG hushing goes away.
No, it's a good hope for this year. James, over to you.
Yeah, so I think that what we've discussed continues to highlight that the absolutely key risk comes from sustainability. That if you're an investor and you're not thinking about sustainability risks, you're not doing your job properly in managing your clients' funds. Governments are not doing everything they should be doing either, which arguably makes that risk even greater from an investment perspective. We're storing up challenges for the future. And so it's actually, I think, provides an argument for doing even more on sustainability. And we all need to work together to tackle some of these challenges. But I think we also need to think about it under the context of value creation. This is how we drive investment. This is how we create jobs of the future. This is how we advance our economies and access private capital to make that possible. So to me, it's about figuring out where the win-wins are. How do we create the economy of the future and get great returns in the process?
And what would you say is your one hope for 2026?
So in 2026, I would like to hope that the asset owners start really recognizing more clearly their power in the investment system. They are long-term actors. They are impacted by systemic risks. They are impacted by long-term changes, and they need to start thinking of themselves much more in the driving seat, creating that long-term future and shaping that long-term future. And so I'm hoping that the asset owners start to use their power more over the year ahead.
James, Mette, thank you very much for joining us.
Thank you.
Thanks, David.
Thank you for listening. And if you've enjoyed today's episode and are interested in finding out more, do take a look at the links in the show notes where you can find the blogs on policy and governance and human rights. Climate and other topics will follow shortly. Thank you again, James and Mette, for sharing your insights and practical experience with us today.